Welcome to the deep dive. Today we're looking at something maybe a little counterintuitive, doubling up on a dividend stock.
Right.
I mean, you've got tons of options out there, so why put more money into a single dividend payer you already own?
Well, the idea, based on the research we saw, isn't just blind concentration. It's about timing, really. Using certain moments to potentially boost your long-term returns quite a bit.
Okay, so how does that work exactly? Dividends boosting returns.
Yeah, there are a couple of key ways. First, dividend reinvestment plans, DRPs, they automatically use your payout to buy more shares. Small amounts, but they add up.
So your stake gets bigger over time.
Exactly. And that means bigger future payouts. Plus, many of these companies, they voluntarily raise the dividend per share pretty regularly.
Right.
So you combine reinvestment with those dividend hikes, and even what looks like a small yield, say 2%, it really starts to compound powerfully over the long haul, especially if you add more shares when the conditions are right.
Got it. So our mission for this deep dive is to figure out the specific thinking behind doubling up on certain dividend stocks. But, and this is crucial, you absolutely can't ignore the health of the actual business.
Well,
Right?
absolutely not. You still have to be really choosy. It's not a blind strategy.
And the research we looked at points to three specific companies as interesting possibilities right now. Target, Dollar General, and PepsiCo.
Three very different situations, too.
Okay, so let's dive into the first one, Target. Now, if you just glance at the headlines, the numbers maybe don't look that great immediately.
Yeah, that's fair. Management's expecting sales to dip a bit in 2025 compared to 24, and the dividend raise they announced back in June, it was small, less than 2%.
Which, if sales are slowing, that kind of news might make investors a little nervous.
Oh.
Is the dividend safe long term? Is something wrong?
That's exactly the kind of question it raises. But with Target, you really, really need to zoom out.
Zoom out, how so? Well, the fascinating thing is Target's dividend yield right now, it's actually over 4%.
Over 4%. Yeah, and it hit its highest point ever earlier in 2025. Now, sometimes a super high yield means the market's worried, thinking maybe a cut is coming.
Okay.
But connect that to the bigger picture. They did raise the dividend, even if it was small. That shows management's commitment.
Right.
And this commitment is huge because Target isn't just any company, it's a dividend king.
Dividend king, meaning?
Meaning they've raised their dividend payout every single year for over 50 years. 50.
Wow, okay, 50 years straight. That's quite a track record, especially in retail. What does that tell us?
It tells us there's a deep culture of returning cash to shareholders, and it also points towards maybe an underappreciated growth story happening behind the scenes.
Growth, beyond just selling things in stores.
Exactly. Target's building out its digital side and focusing on things with better profit margins. Like they're getting more into advertising on their platform. They're letting third-party sellers onto their website, their e-commerce site.
Like a marketplace model.
Sort of, yeah.
Yeah.
And they launched that new subscription service, Target Circle 360.
Right, heard about that.
Other big retailers have used these kinds of strategies, digital ads, marketplaces, subscriptions, to really boost profits. So even if the 2025 sales outlook isn't, super exciting, Target seems to have a clear path to grow profits long term and keep raising that dividend.
So for someone already holding Target.
For an existing investor, yeah, seeing that yield over 4% near its all-time high in 2025, while these other profit streams are building, that looks like a strategic moment, a chance to potentially add shares, double up, while the market might be too focused on the short-term sales picture.
Okay, that definitely puts Target in a different light. Let's pivot now to Dollar General.
Okay.
It's another one often seen as maybe a lower growth kind of business.
Right.
But the investor anxiety here seems to stem from something different. A really steep drop in profits recently.
Yeah, that's the big question with Dollar General, or DG. Why did profits plunge? I mean, earnings per share, EPS, fell over 30% in 2024.
Ouch. That's never good for a dividend stock.
Never. And the core issue boiled down to inventory. Basically, Dollar General had way too much stuff.
Too much stuff. Like literally just overflowing warehouses.
Pretty much. Their inventories grew much, much faster than their sales, peaking sometime in 2023. So management had to work really hard to clear all that excess stock out.
Which means discounts, write-offs.
Exactly. It hit profitability hard. It was necessary medicine, but it definitely hurt in the short term.
So it was a correction they had to make. But how do we know they're actually past it? Is this recovery real or just a temporary bounce from clearing out the old stuff?
That's the key, isn't it? Sustainability. And look, they definitely faced some tough decisions to get inventory back under control. The positive sign is that after a couple of really rough years, DG does seem to be getting back on track.
Okay.
In the first quarter of 2025, their EPS actually jumped 8% compared to the year before.
8%. Okay, it gets better.
And management is forecasting double-digit growth in EPS for the full year 2025.
Double digits. That's a significant turnaround.
It is. Now, we have to be clear. They still have a ways to go to get back to where they were, profit-wise. It's not like they're instantly back to peak performance.
Right. Recovery takes time.
But the dividend yield right now is over 2%. And historically, that's actually pretty rare for Dollar General.
So another case of an unusually high yield for the company.
Yeah. And with earnings expected to rise, that gives them plenty of room to keep growing the dividend in the future. So for an investor already in DG, seeing earnings recover and getting that rare 2% plus yield, it signals the market might be starting to reevaluate the stock. Could be a short window to double up before profitability fully recovers, and maybe the stock price reflects that more.
Interesting. Okay, 2 down. That brings us to our final company, PepsiCo. P.
Pepsi.
This one often feels like maybe the safest bet of the three. You know, consumer staples giant.
Mm-hmm. A household name.
But the stock hasn't done great lately. It's down, what, about 30% from its high back in 2023?
Yeah, roughly that much.
And the common thinking, or the easy assumption, is that it's because consumer habits are changing. People moving away from sugary drinks, traditional snacks.
That's the narrative you hear a lot, definitely. People worried about Ozempic's impact health trends.
Right, but what do the actual numbers say?
Well, this is where it gets fascinating. The numbers, they don't really back up that story of rapid decline.
Oh.
In the first half of their fiscal 2025, beverage sales volume was basically flat year over year. Flat.
Okay.
And their convenience food volumes, down just 2%.
Just 2%. So volumes are holding up pretty well then.
Yeah, I mean, overall sales volume is like within spitting distance of its all-time highs.
Wow. Okay, so that narrative about the business quickly going out of style because of changing tastes.
The data doesn't seem to support it, at least not drastically. The business looks pretty resilient.
So if demand isn't falling off a cliff, what does that say about PepsiCo long term, especially considering that stock dip?
It suggests, well, significant resilience and adaptability. PepsiCo is huge. It's one of the biggest consumer goods companies on the planet. If consumer tastes do shift significantly, they have the scale and the cash to just buy their way into new trends.
Acquire smaller, faster-growing brands.
Exactly. We've seen them do it. They reportedly bought that prebiotic soda company, Poppi, for maybe $2 billion.
Okay.
And they did a $1.2 billion deal for Siete Foods, that Mexican-American food brand. They can pivot. They can adapt by acquisition.
So they can stay relevant even if specific categories change.
That seems to be the strategy. And here's another really interesting historical point about Pepsi. Its dividend yield.
Okay.
If you look at data going back like 35 years, Pepsi's dividend yield has never been over 4%. Until 2025.
Never in 35 years.
Never. And right now, it's hovering pretty close to that 4% mark.
So similar to Target and DG, a historically high yield point right now.
Exactly. So if you believe in the long-term strength of the core business, its ability to adapt through acquisitions, then seeing the stock down while the yield is at a multi-decade high, that could look like a really attractive opportunity to double up for the long term.
Right. So wrapping this up, thinking about Target, Dollar General, PepsiCo, there's a clear theme here, isn't there?
Yeah, definitely.
It's about looking past the immediate noise, the headlines, maybe the short-term challenges, and really digging into the underlying business. Is it healthy? Does it have a path forward for profit growth, for dividend growth?
Precisely. It reinforces that idea. You have to be choosy. You need to understand why you own what you own and why you might add to it. It's not just about chasing yield blindly.
No, absolutely. The business fundamentals have to be there.
That's it. Knowledge is great, but it's most powerful when you actually understand it and can apply it critically. Don't just react to the chatter. Dig deeper.
Well said. And that leaves us with a final thought for you, the listener, to maybe mull over. What other companies out there, ones that might be overlooked right now because of some short-term story or perceived problem, could actually hold hidden long-term value, maybe even dividend growth potential if you just took that deeper dive into their strategy, their adjustments, their real underlying strengths? Something to think about.